I'm joined today by Dr. John Weicher, a Senior Fellow and the Director of Hudson Institute's Center for Housing and Financial Markets. John Weicher has a long history looking at these markets as the Assistant Secretary and the Federal Commissioner, Federal Housing Commissioner at the Department of Housing and Urban Development from 2001 to 2005. And earlier as the head of development and research and HUD's chief economist. John, the housing markets are on everybody's front page today, and the implications of the housing markets, I wake up every morning to something like this, and I'm beginning to wonder if we're ever going to see the font size on these newspapers get back to a normal level. What's going on here? This all started with subprime mortgages. Why has it spread out so much?
Well, many financial institutions hold subprime mortgages, or they hold securities that are backed by pools of subprime mortgages, essentially bonds backed by pools of subprime mortgages. Or they've lent money to institutions that hold subprime mortgages or mortgage securities. Or they've insured subprime mortgage securities. And so when there is a problem in the subprime mortgage market, that creates problems not just for Fannie Mae and Freddie Mac, which hold subprime mortgages and issue securities, but for Lehman Brothers and Bear Stearns and American Insurance Group and for banks. We've seen recently Wachovia and Washington Mutual replacing their management because of problems which to a substantial extent are problems with subprime mortgages. It just spreads out. Financial institutions do business with each other. They operate in interrelated markets, and there are problems. There are problems for one institution. There may be problems for others.
I rise every morning holding my breath, thinking that maybe we've reached the bottom of all of this as I watch my retirement waste away. How long is this going to last? Are we going to see a bottom at some point?
Well, I think so. Certainly we're going to see a bottom, and it won't be at zero. What happened in the subprime market, along about 2005, lenders started relaxing their underwriting standards because house prices had been going up at about 10% a year for a couple of years, and that suggested to lenders that they could take more risk than they had previously taken. And so in the expectation that rising prices would enable people to stay in their homes, meet their payments. If they got into trouble, they'd be able to sell the house and pay off the mortgage. Well, as we know, prices didn't go on rising at 10% a year. But what lenders did, if you look at the performance of loans in general by the year in which they originated, you can see that loans originated in 2005 have not performed as well. There have been more defaults than was the case for loans originated in 2004. And the same is true for loans originated in 2006 compared to 2005. And it's also true for loans originated in 2007 compared to 2006, although by the middle of 2007, lenders weren't making very many subprime loans anymore. But each year's cohort of loans was riskier than the cohort before. And so you have had that turning into higher defaults on each year's cohort of loans. And normally when loans are bad loans, the problems occur in the first couple of years after they've been originated. So that suggests to me that we're going to go on seeing problems with defaults in the subprime market through the middle or latter part of next year, of 2009. I think we have probably passed the peak in defaults simply because, as I said, by 2007 that market was beginning to dry up. But we're going to have a problem for perhaps another year.
Well, that suggests that the foundations of many of the other lending institutions are going to continue to weaken for some time. Are we going to see more banks and insurance companies go bankrupt? I mean, we've now seen Bear Stearns, Lehman Brothers, AIG. We see Morgan Stanley looking for a savior. Goldman Sachs may be in trouble. Who else is out there, and what's going to happen on Wall Street?
Well, I don't think you know about a company unless you're in the company, and maybe not then. Or perhaps if you're in the Treasury and tracking these things closely, or in the Federal Reserve Board and tracking them closely. It's only a couple of months since we saw the first very low-key discussions on Wall Street of possible problems for Fannie Mae and Freddie Mac. I think it was July 7th when an analyst for, if I remember correctly, Lehman Brothers said the new accounting standards may pose problems for Fannie Mae and Freddie Mac, and therefore I expect that the accounting standards will be relaxed. Within a week of that, Fannie Mae and Freddie Mac were in great trouble, and it was clear that the government was going to have to do something. So that in 2 months from a standing start, before that there was very little. People were talking about problems, but there was very little about major financial failure. So I don't think you can predict individual firms unless you are on the inside, and that I'm not, and don't pretend to be.
Well, this, of course, has all spilled over into the presidential campaign. What are the candidates saying?
Well, it has and it has not. It has not been something they have been talking about in great detail. They've said broadly similar things. Both Senator McCain and Senator Obama have said that the structure of Fannie Mae and Freddie Mac had to be changed. They both expressed concerns. They both supported the major housing bill that passed at the end of July, although neither voted at that time. Neither voted either for it or against it, but they're on record in supporting the fact that something needed to be done. Senator McCain was supporting reform of Fannie Mae and Freddie Mac at least as far back as 2006, and perhaps earlier. Senator Obama wasn't saying much about it until it became an issue over the last month. One big difference between them that's important here is taxes. Senator McCain has said he would lower taxes. Senator Obama said he would raise them on interest and capital gains and on higher income wage earners. I don't know of any system of economics that says that you raise taxes when the economy is weak. You either lower taxes to stimulate the economy or you leave them alone. Raising taxes discourages people from working, from saving, investing, tends to prolong a problem and makes it harder to solve.
Sounds to me like this is a story that's going to have a lot more movement in it, and we'll need to come back and confer with you further down the road, and certainly closer to the election. My guest has been Dr. John Weicher, the head and director of Hudson Institute's Center for Housing and Financial Markets. His work can be found on the Hudson website at www.hudson.org. John, thank you very much.
Thank you.